Not yet, Srini.
You're not seeing?
Not yet, at least. Now it's popping up. Yep,
Okay.
thanks.
Okay, cool. That's what I didn't hear
Yeah,
from you.
you can see it now.
Okay. You can see it, right? Okay.
Yep.
So today we are going to talk about a topic which is very, very, I get this all the time. People grow small trading account. When I say grow small trading account, I talk about people like, nowadays we hear a lot of people opening up a Robinhood account and then they start trading with like $1,000, $2,000, $3,000, like this kind of accounts, right? So basically, how do you grow these accounts? Okay, and not only growing them for for consistent growth and returns. That is what we are going to talk about today. So before we get started, let's talk about the disclaimers because this is all the information presented in this video is only for educational purposes. The viewers, that is you can use this information for considering your own investment decisions. However, you will be solely responsible for evaluating the information and to make your own decision to buy, sell, or hold investments. Okay. So having taken care of the disclaimer, let's move on to the training. The first one, first let's go to the agenda. The first what we are going to talk about, what is the easiest way to grow a small trading account? And then we'll talk about some of the trading laws. Then the third one is we'll talk about what are the 3 elements that you need for successful trading. Okay. And then we'll talk about equity models. What are the different kinds of equity models that people use? Every trader can have its own equity models, right? Then finally, but not the least, how to grow a small trading account effectively. Okay. Now, let's see. Let's go to the next slide. So easiest way to grow fast. Let's say, I'm just giving a hypothetical example here. You have $500 and you double on every trade. So it is like a for geometric progression, right? Every 500 you become 1,000, 1,000 becomes 2,000, 2,000 to 4,000. So if you go this route, how many trades do you need to make it to a millionaire? Like how many trades? Any guess, guys? Okay, no guesses?
Maybe 9.
Correct.
2
Yeah,
to the
you're
power
very
of 9,
close,
right?
right, you're very close. If you do 10 trades, whopping 10 trades, you'll have $1 million and you can have a winning dance, right? But the real question here is this feasible? Is it feasible, right? The question is absolutely not. This is not feasible at all. The reason is only as per the statistics, first of all, in the trading world, only 5 to 10% of traders are successful. And these people, they understand the capital preservation is very, very important. And that needs to be done through position sizing. And they understand the trading laws. So, uh, so why I'm telling it's not feasible? Number one, the maximum probability, you have to understand, guys, trading is a probability game. And the best traders who have like made millions of dollars have a ratio of 0.7. Okay, that means they win 7 trades for every 10 trades. So even that is the ratio, guys. So here we are talking about, hey, how can we make like a small account fast to $1 million? So that is definitely not feasible. And as you do more and more trades, there are going to be some more and more losses, and there are going to be some wins. As long as you have the edge of more than 50%, you will definitely make money. Okay, that's what it's all about. So let's move on to the next slide and see what are some of the trading laws that everyone should be aware before getting into the trading. Okay. First of all, these guys always they take care of the downsides through position sizing and RRR. When I say RRR, it means it's risk reward ratio. How much risk are you willing to take for the reward you want? For example, if you are looking into Tesla options, if you don't do any position sizing and you say, hey, this happened to us, what happened is some of the people, they doubled their amount on the Tesla on their battery day. And what happened? The Tesla went down and they lost a lot of money. So so what I'm trying to say is you can lose the whole account if you do one trade like that without any proper position size. So a good trader will understand that trading is a probability game, and he doesn't know which trades will go successful or which trades will not. So he will properly play his position sizing and risk reward ratio. Second thing he thinks is consistent action leads to consistent results. That means he's always trying to be consistent with his actions. What I mean by that is, so like even this happened to me when I started out. I used to put position sizing for some of them, and for some of them like Google results, earning results, or Apple earning results, I never used to do position sizing. So what happened is whenever I made a mistake, I lost minimum of 4 hours. Let's say my risk is 50%. That means I lost 200% on an option trade. So think about it, guys. If I have to make that 200%, I have to actually, when you lose something, to get back it has to be double the effort. So it is very, very, very critical to be consistent in your actions, and you have to be like very disciplined on that. Third one is develop an edge in the market. Remember, I said that it is enough as a trader if you just have an edge of at least 51%. That means even if you fail 49% of the time, if you win 51% of the time, you will still be making money. Okay. So that means you need to develop an edge. That is where the systems, what we talked about last week, the frameworks come into the picture. This one should beat in all kinds of market conditions. For example, there are 6 kinds of market conditions, right? 3 basically, which is bullish, bearish, or sideways. Now you want to say for bullish, there can be 2 conditions. It can be a volatile bullish or it can be a quiet bullish. Similarly for bearish, it can be volatile bearish or quiet bearish. Similarly for sideways. So you need to have a system that works for all these 6 kind of market conditions. That's what I meant by that. Okay. So that is where you develop an edge. Then they work with large numbers. This is what I meant to say is people say, hey, I had developed a system and it is working good. But when I ask them, how many trades have you done with the system? They say, hey, I've done 10 trades. So in a 10 trade, it's a very small number when you're considering an edge, okay? You need to have at least 50 to 100 trades to see if your system is working. So that means you need to really work with large numbers. In the trading world, in the algorithmic world, algorithm trading, they use the term called back testing. They test it so much testing has to be gone before you, understand that you can use this algorithm automatically. One of the famous algorithm trading today we see is the moving averages. People just buy the things when they come across the moving averages, and then they sell out when it goes below the moving average. So those are all proven things, but you need to do a lot of back testing. Okay, that's one thing. Then this is very, very important, guys. Let's say you have a very small account. Let's say you have a $10,000 account, and your position sizing. Let's say you're saying for every trade I will put 1%. That means you are at $100 per trade. Now, when you say $100 per trade, you are not going to make a lot, right? Like $100. Even if you make 100% on it, you'll make another $100. It is not going to make a big change in your portfolio. But what if, let's say you're doing some kind of a regular contribution, and you're adding every month $500, right? As you keep increasing, at the end of that year, you will be having 16,000. And on top of that, if you are making some trades already, that would have been compounding, right? The returns and all those things. So you have to understand more money is needed to make more money. You cannot say I'll have a fixed amount. If you have a fixed amount, your returns will be fixed. So you need more money to make more money. You have to understand that power, okay? Then along with that comes the leverage, the power of compounding. So people say, hey, I want to take away my returns, take away my profits. If you take off, you have to understand the compounding effect is gone. So let's say maybe, especially in your long-term accounts, right? You want to keep it longer and keep contributing regularly. so that you buy it at the lower prices and you kind of average it out. So you leverage the power of compounding. So once you that means every time you buy, you're going to get more money, and then as your money grows, as the stocks grow, you'll make more money, right? So that's one. This is very, very important, guys. The next one, the no single best trading strategy that works over 100%. That means there is no single strategy, guys, that will always work. You got to remember that. There is no holy grail here. It is just that, think about it, guys. The stock market is very, very subjective. For people who are from IT, you know that your system, that you're designing a system in IT, you know that the system should work in this way and it should be 100% no errors in the system, because you know what you're doing and what you're doing. But think about it in a market, right? A single scenario, like let's say today, Facebook went down, right? There was a discussion in the WhatsApp group that we have. Some people love to play the downside. Some people love to say, hey, it went down, let me average it up and see what it has. Some people would say, hey, let me put the spread and play it very safe. So there are three different ways you can play a single trade based on the market conditions. So you got to understand that no trading strategy is wrong. It's just that, are you able to get out of the trade with minimal risk and maximum profit? That is the whole point, right? So it depends on what you want to do with the trade. Now, this is very critical. Higher frequency leads to more profits. Why I say this? Let's say you're tossing a coin, right? And you say, every time I make a head, I'll make $2. And every time I make a tail, I'll make $1. If you do it for one time, there's a probability that you will lose, right? You will only make, you will give $1 if you get tails. If you make heads, there's a probability you will get $2. Think about it like that. Now, if you do only once, then what happens? There's a very good possibility that you might lose the dollar. Now, let's say you toss for 50 times. Now, it's a 50% probability, right? So 25 times 2 is 50, and you lose 25 times. So still you made $25. Are you getting the math, guys? The point is, the higher the frequency of the trades, the more you will be able to make. So similar like tossing a coin, but in the tossing a coin, it's a 50% probability. Whereas the trading, you can talk about 80% probability or 70%, 75% probability, okay? And last but not the least is, trading is not a quick risk scheme, guys. It is it's a myth that people carry out. Oh, that's very easy to make money. It's very, people talk about, see, for example, you see all the time on the internet, on the thing, hey, he made $6 million on the trade. For example, I saw this Perishing Capital who predicted the market downfall and all those things. But nobody saw how many times Ackman lost money on one of the, I don't remember the name of the company, if you guys can do. He lost so much money on that networking company, right? It starts with, I forgot that. Herbalife. He lost on Herbalife, right? So it's an even game, guys. So you got to understand, it's a slow risk scheme. As long as you play the probability game correctly and you use your position sizing with the risk to reward ratio and you develop an edge in the market, as I said, then it's a very rewarding game. Basically, you will be able to make money whenever you want, and you will be able to make the amount that you have set yourself for. Okay, but for that you need to spend some time. Okay, that's what it is. So let's move on to the next one. So what are according to 3 elements of successful trading, guys? As per the statistical research, your success in trading is dependent on 3 factors, okay? Sorry, I have a typo here. So the number 1 is the trading psychology. The trading psychology is 60%, guys. That means you don't know anything about trading. You don't know any market. You don't know any trading strategy. You don't know anything. But if you are very aligned with the markets and your beliefs about the markets are very good, and your actions are aligned with your beliefs, then you can definitely make a lot of money. I've seen some traders who don't know anything about the strategy, but they just look at the price action and then they just do it and those kind of things. Okay. Then the second is the position sizing. Position sizing is 30%, guys. It's a proven fact that if you take as I mentioned, if you take a large number of trades, 100 trades, and you just do only based on position sizing, right? You don't have any system in place, you don't have anything. Still, if you do the position sizing correctly, you will still end up making money, guys. But how much? It's a varying factor. But it's proven that position sizing is very, very critical, guys. As you see here, trading psychology is 60%, position sizing is 30%, and the systems that you develop is only 10%. So it's been kind of surprising, right? That systems only contribute to 10% for successful trading, which most of the people think that, oh, it is the most important thing, right? But it is not. It is very, very important to have your position sizing in place, guys. That's critical. So what is trading psychology? It's all about your beliefs, guys. What do you believe about yourself? Let's say, I'm not, I have been in this. Man, have you ever heard yourself saying that, man, whatever I touch, the market is going, I lose. You know, you don't have to respond, but most of us have been on that boat, right? Man, whatever I touch, I end up losing. So why is that? So first of all, some people say, man, I am not good with the markets. Markets, I never make money in the market. They say that. So it is their belief about the market. Some people say a market is a gambling, right? It should not be. Why? Because even my parents say that, because they say market is a gambling, so you shouldn't do that. It's a bad habit to do gambling. So, I grew up with those beliefs too, but it slowly changed. So why I'm telling this, your trading psychology, right? Let's say you believe that you don't make money in the market, then how would you take action that will take you to make money in the market, right? Think about it. So it is very, very important to understand yourself. First of all, what is your belief about it, right? Then second thing is, again, this is since trading involves money, guys, what is your relationship with the money? Some people believe money is evil, all right? Again, I'm not bringing anything. If money is evil, too much money, it will create a lot of problems, those kind of things. If you're going to think that money is evil and it is going to bring a lot of problems for you, how will you do any actions that will get you more money? You see the contradictions, guys? Your beliefs, and your actions. If your belief is subconsciously in with the belief that money is evil and too much money will create too many problems, then that is going to reflect in your actions, right? That is what is very critical. This is done by, again, these ideas are taken from trading from a very well-known trader called Van Tharp. He's he does neuroscience and also trading. He combined these and he has done a lot of good information. I've already suggested this book for those of you who haven't read. It's a book called Super Trader. It's a phenomenal book, which talks about what are the various things you need to be successful. Okay, so that's it. Then third thing is, what do you believe about markets? What do you believe about markets? For example, you think, let's say, I remember one of our subscribers 3 months ago or 2 months ago, not 3 months, maybe recently, he believed that the markets are going to go down. And if he believes that the markets are going to go down, why would he trade something that is going to be bullish, right? So you got to see, is your actions matching with your beliefs, right? No, that is one thing. Then the second thing is, let's say you believe only in buying low and selling high. Let's say you're a value trader. Then if I say, hey, this stock is going up, let's say Tesla is going up, then why would you buy that? Because you don't believe in buying it so high, right? Like, for example, $500 is too high. A lot of people who are value traders, they are not even in this market. I've seen a lot of people who are away from the market since February when it fell. They felt the market went up too fast and they are expecting a V-shaped, downfall again. Again, there's nothing wrong in it, but you need to trade according to your beliefs. So for that, you need to understand what are your beliefs. You need to spend considerable time in understanding yourself and your beliefs. Okay, that's all I'm trying to say. There is nothing right or wrong here. Any belief is good. Only thing is we need to be aligned with our beliefs, and we need to take actions according to that. Okay, that is trading psychology. The second thing is, what are systems? As we discussed in the last webinar, uh, I wanted to talk about this before I talk about position sizing, because position sizing involves a little more depth in this video, in this webinar. So let's talk about the systems. As discussed in the systems are the framework that gives an edge for you over the market. So for example, I use different things. Right? I use for my scanner, I use Ichimoku. Then for my entry points, I use my flat lines and my Feb retracements. Then for my exit points, I use my Feb extensions and GAN. And for my options time, I use trend lines and I use my GAN fans. Okay, and I also use GAN square of 9 for my entry and exit points. So I have a system, I have a framework that covers the entire trading life cycle, right? So this is called a system. And does it work every time? Absolutely. The reason being is I only look for the stocks that are going up as per technical indicators. So those works for every market condition. So I'm just giving you an example, guys. So this is how you develop a system. So sometimes people can have more than one system for different market conditions. So in my case, I have one which I can fine tune for different market conditions. But some people may have more than one system. Like one system they'll use when it is bullish, one system they will use when it is bearish, those kind of things. So the system, right? We need to measure. How is it measured? It's measured by your winning probability and the number of trades it produces. Let's say you have a system and it produces one and it gives you 100% returns, but it can only produce that kind of a system, that the signal, it only produces one per month. That means you can have like only 12 trades per year, right? So that is how it is. So are you okay with that? That is the first question you have to think about. So if you want a system, so that is what, so if that system fails, if you get only 12 trades and if 5 of them fail, then you're having only 70% probability. So that's what you have to measure. And if each one gives you only 20%, so those kind of things, you have to measure your winning probability and the number of trades it produces. So one important thing is, how do you define a system? Your system should be defined by your risk. What I meant by that is how much risk you are willing to take and how much is the reward that I'm getting it for. So when I say R multiple for it, it's the risk multiple. For example, if for any trade, let's say I am in an option trade and I say I put $1,000, my risk is the whole $1,000, right? Now I get to, but my reward is I'm expecting 3R. That means I'm expecting 3 times. So my risk to reward ratio is 1:3, right? So that is a good system. Or it is more than, even if it is 1.5R, that is also a good system because you're still winning in that trade, right? Those kind of things. So R multiple for every trade, and then mean risk, standard deviation. All these are the metrics that you can measure for the system. We'll talk about it later. I'll show you our tracker, how we have done this. And what is our, you'll see how our R multiples are and all those things, okay? Generally speaking, a system with a ratio, what I meant by the ratio of R mean to standard deviation, if that is greater than 0.25, you will be profitable. So this is how it should be. So guys, but it is very, very challenging to develop a system. At the max, you can have like 0.7, as I was mentioning, as for the trader. So, but if you have even 0.3, 0.4, it's pretty good. Okay, that's what it is. So, okay, position sizing. The third element of the successful trading is position sizing. So, position sizing, what is it all about? it is proven that the same portfolio can have different results if the amount elected to risk is different. So this has been an academic study. In 91% of the performance variations of 82 retirement portfolios are due to position sizing. That means for the same portfolio, you can have different results. I can also show this in our tracker. It will be very different for different ones. Okay. So you got to, what does this position sizing depend on? So there are three components of position sizing, guys. Number one, again, comes to trading psychology. What beliefs does the trader operate on? What I meant by that is, hey, the trader is very fearful, and he says, hey, he might have a belief saying, I would never want, I'm too scared that I would get bankrupt. So what he will do, he will be very critical about his position sizing. He will maybe play very little amounts in his position sizing. Whereas there will be a trader who will say, I don't care, I will win at any cost, right? So this trader may be a little bit more aggressive. He might have 2 to 5%, like a more 10% of the trading. But he needs to understand what are this and what are the emotions behind it. Is he fearful, or is he aggressive, or is he brash? I mean, whatever the emotions are very critical, right? Then the second one is trader subjective. As I mentioned, this is what it is. So how do you do these kind of things? The trading psychology is very, very important. As I said, the trader operate on what does he think about the market? Where is he heading to? And all those kind of things, right? Then the last is the model. How do you determine the position sizing method, which is called the CPR model? Okay, let's talk about this. So what is CPR? C is the cost. That means how much of your equity are you going to risk? That means how much of your capital. Then P is how many units are you going to buy? And R is how much are you going to risk per unit? Now P is given by C divided by R. Okay. Now let's go to the next one. I'm going to give you an example here. Since we predominantly trade options in our thing, I used an options. And a lot of people have been asking me how to do this. So I'm just giving this example. You buy a weekly Facebook option with a risk of 50% per contract for $5. You want to risk 2% of your $100,000 portfolio. I put here 10,000. Okay, that's fine. It should be 100,000. Okay. How many options would you buy? If you say R is 0.5 per contract and C is 2,000, how? 2% of 100,000 will be 2,000. Now, what will be the P? P will be first, if you take 2,000 divided by 5 is 4. But what you're telling me is I want to take away if it goes below my 50%. That means you have a stop loss at 50%. If you have that kind of a stop loss, then you can play more options, because that means instead of you can buy 8 contracts with 50% stop loss placed. Now take that other example. I say, hey, I don't mind if all the 2,000 is gone. Okay, that means you're taking 100% risk. Then you want to still risk the 2% of your $100,000 portfolio. How many options would you buy? So if you see here, in this case, it's only 4 contracts. So if you look at it, if you take your risk reward ratio and the position sizing, you can determine how many contracts you want to buy. Ideally, if you will be profitable if you're making more than 1 hour per trade. That means how much ever is your risk, if you're making more than that, you will be profitable. Okay. Now, any questions, guys, so far? Does that all make sense? Folks, are you there?
Yes.
Okay. Any questions?
Oh, good.
Good. Okay. Okay. So equity models, right? Again, how do you allocate the models, right? There are multiple models available, guys, and you can determine your own model, how you want to do. For example, you can do asset allocation, and you can do some kind of if I'm trading certain kind of stocks, I'll put more tech stocks, tech options. I will do a little bit more less risk. I'll put more less position sizing. Whereas if it is a utility options, I'll do more. People do different kind of things. But if you're talking about a generic way, I'm just giving an example here. Let's say we are assuming we are allocating 10% per trade with a total portfolio of 100,000, right? There's something called as a core equity model. So what it does is it subtracts the allocation of the trades placed and takes 1%, subtract 1%. So let's say you're allocating, sorry, 10%, right? So the first trade is $10,000. That means you took 10%, so it is 10,000. So the next trade will be how much? That means 90,000. That means 90,000, you'll only allocate 9,000. The third trade will be, once you allocate those two trades, you'll have 81,000. So you will get $8,100 for the third trade. This is a very common way to do this. Basically, you will allocate this kind of core equity model based on this. There's a second type of fund called total equity. What it does is it takes into consideration your profits and losses also. Let's say the first trade where you allocated 10,000. Now let's say its value came down to 8,000. For the second trade, 8,000, right? So I'm sorry, this here, did I do the math right? Wrong, right? So it should be 88,000, 8,800. Sorry guys, the calculation wrong. Second trade, you'll have 88,000 available because you took away the 10 trades and the 2,000 is also. That means you're at a loss of 12,000. So for the second trade, you will be only able to allocate 8,800. Okay. So that is how this total equity works. So these are two very common models which we can use. So do you guys know of any other models that can be used? Okay, silence means I'll just move on. So finally, so how to grow a small trading account, right? I would ideally, right, especially if you're trading options, or if you want to become a trader. I'm not talking about investor who puts in the dust, who just puts it and leaves it for a long time. I would recommend to have at least 25 to 30K to do trading. Why? First of all, this is the limit. 25K is the limit set by the SEC to do trading, right? They want to protect the traders from complete losses. There is a reason why they keep it, right? So, I mean, there are alternatives to it. You can open an account offshore and then you can still trade it with a small and become a day trader, right? A lot of people do day trading, open a offshore account where there are no restrictions like that, and then they trade. But still, I personally feel it's like buying a home, right? There is a decision that whether you want to put 5% buying a home with a 5% down, or you want to accumulate the 20% down. So, I mean, I personally prefer accumulating 20% down. So that is how I would like to do. So if you do not have that kind of an amount, work on the accumulation. Meanwhile, work on the systems and do the paper trading. The second most important thing is have a trading plan, guys. This is very critical. We are going to cover this in detail in the next webinar. What are the various components of the trading webinar, trading webinar, right? I mean, trading plan. What does it need to have? For example, it needs to have like, what is your contingency disaster plan? Let's say you have an emergency. For example, let's say someone in your family, I don't mean to say that, but someone in your family met with an accident and you have like 5 open trades set up. What do you do in that time? Like, your mind will not work because you're thinking through so many things. So do you have a contingency disaster plan? That is also a very important part of the trading plan, right? You need to mentally rehearse all the steps where you are going, right? Where what you would do when certain things happen, because that is very critical. So we'll talk about it in detail in the next one. For those of you, why it is very critical, I also want to give another example. For those of you who are in biking, right? There was a very good cyclist who practices every day, and every time he goes at a super speed, he there was a very good chance of him getting into an accident or anything on accidents. So what he did was, there are two options. Whether as he was getting old, He could either stop biking or he could mentally rehearse his exit options. So he kept on rehearsing his options. What would happen if this happens, or like this situation happens? So he mentally rehearsed for it. And like one day, what happened when he was going at a very heavy speed in the traffic, he saw his tire bulging and it was going to break out at any point of time and he would be flying into the traffic. So what he did was, according to his mentally rehearsed plan, he just tilted over and put the bike on top of him so that he doesn't fly into the traffic. Again, is that the best way to do? No, but he was able to execute his plan because he was able to mentally rehearse it. So we'll talk about it in much more detail in the next webinar, but that is the importance of having a trading plan. You should mentally have it written, and it should be a written contract with yourself. And you should mentally, when you're trading, you should always have that in the back of your mind. Okay. Then start with a small position sizing, guys. I would not recommend you to go more than 1 to 2%. If you are a beginner, start with 1, max 2. If you are a little bit novice, go for 5, not more than that. Okay. Definitely work on this small position sizing. It matters a lot how drawdowns happen. If you are a person with a, let's say you have $100,000 account, right? And you have like, you are playing with a 10%. How many, let's say 10%, then what happens? If you have 10 trades in a row which fail, that means you are broke. So is that what possible? Is your system, what is your system saying? Are you able to get, I mean, can your system promise you that you won't get into 10 continuous failed trades, right? So we got to play it very safe, and we got to adjust our system so that we can get more reward for your risk. Okay. So work on a system that provides you an edge, guys. We know that that your money doubles according to the money. If you make 18% per year, your money will double in 4 years, right? If you make 24% per year, your money will double in 3 years. It's just a simple math, guys, according to compound interest. So 72 divided by whatever your percentage will be, that number of years, right? So if you make 36, your money will double in 2 years, right? So you got to understand what is it that you want. Unless you know what is it that you want to achieve, you cannot go there, right? Just like how you're driving. If you don't know where you want to go, how will you go there? Similarly, these all will be part of your trading plan, guys. What is your objective? Why are you trading? What do you want to achieve? Okay. Then second, that again, do not remove the money, right? Treat it very seriously, guys. One saying, as Robert Kiyosaki says, who is the author of Rich Dad and Poor Dad, invest in yourself before anything else. So if you're treating trading as a serious and you want to achieve your financial objectives, then do not remove the money. Understand the power of compounding, what it can do. Okay. Then again, as per trading law, what we saw already, money makes more money, right? This is very, very true, guys. I've already seen that why hedge funds continuously work on increasing their capital, because bigger accounts are easy to grow with minimum risk. Why? Bigger amounts, because when the amount grows bigger, your position, as per position sizing, even if you take 2%, your amount will be bigger. So your profits will be bigger. I can show you that also in in our trackers. Okay. As you add more money, amount increases for position sizing. That's what it is. So that's what I wanted to share with you folks. So understand why position sizing is so critical for your success and make it a part of your trading process, right? So this is very, very critical, guys. So any questions based on this? Folks, there's nothing right or wrong. You can feel free to ask any questions. We have all been there. We have all made mistakes. Maybe I'm showing something wrong. You have something to add.
Good info, Srini. Thank you.
Okay.
Yeah, I have my son next to me, so I'm muting myself.
Okay.
So
And Srini,
Yeah.
Srini, do you have other slideshows? You know, the ones that you presented before. Do you have it archived somewhere that I can go and?
Absolutely. It's in our trading blog.
Okay.
If you go under our trading blog, let me show you, guys. I've been getting this question. Let me show you myself. 1 second. One second, guys. Are you able to see the screen, guys?
Yes.
This is our website, TechieInvestor. If you go here and look at the training, we have all these. The last week training was top 5 things to watch in stock market to trade with. Then we did how to use Gann square of Gann square of 9 strategy and all those things. Okay, so you have everything here, right? And yeah, you have everything. If you need anything else, also please let us know. We have everything presented here. So, did that answer your question, or do you have any like that?
No, that's what I was looking for. Thanks.
So I wanted to talk a little bit about, as I was mentioning before, so we have created the blogs for you guys, and so I wanted to talk a little bit about the returns, what we are talking about. So we have created this tracker which tracks our services live. Uh, okay. So if you remember, so far we have like, what I wanted to more talk about is like, if you remember in the slides, I was talking about R multiple, right? R multiple, what is it, and all those things, right? So let me talk about this. So we have maintained the metrics for the systems that we have, which is like total trades is 120. Out of it, we have the winning trades, which is 75, and the losing trades is 45. The reason why I'm showing you is if you are developing for your own trading, you need to have this kind of metrics, okay? So that's what it is. So the trading process, the 50% trades is the minimum that we look for all the time. That came to 58. Now that's trade total gains. Now this is what is trade multiple. Let me show you. In our case, right, what we do is we have a position sizing, which is 2% and 5%. Remember I was talking to you, if your portfolio is 100,000 and the position size is 2% or 5%. Remember, I was telling you guys, if the portfolio is at 5%, the returns will be different. If you look at here, the position price for a 5, the portfolio return is right now at 160%. But if the portfolio size is 2%, it is 63.69%. For the same things, remember I was showing you the slides? For the different position sizing, the returns will be different, right? So this is how it works, guys. So position sizing is very, very critical. So it depends upon how much risk you want to take. When we had the good one thing about our system, where how we designed it, at a time we will have only 10 trades. If we are looking at 5% also, which is 5,000, we will have 50,000 in play and 50,000 in cash. But if you are a very conservative trader, you don't want to do that. You can start with 2, so that is 2,000. That will be like 10 trades, 20,000. So 80,000 will be in cash. So that is how you need to decide on that. Okay, I just wanted to bring that up. And second thing, what I wanted to talk to you about is the R multiple. In our case, our risk is, if you remember the options portfolio, I showed you that we are taking 100% risk on every trade, right? That means we know if you put to 5,000, we are ending up, let's say 2,000, we are ending up losing that $2,000. It doesn't mean that we are taking, but that is the risk we take in the options. So according to that, what we did is the R multiple is 1. Why? Here my exit is 14 and 7, right? That means my risk is 7, but my R multiple is 1. That means according to the risk, I am 1. Here you see I became low, high, and all those things. So all these things, when I add up for the 120 trades that we did from August to this one, it came up to 31.84. Okay. Now, the mean of this is 0.26, right? Then the standard deviation is nothing but, what happens is, it is a formula where you say, hey, standard deviation is nothing but the R multiple that you have for the trade minus the mean, right? That is the R multiple mean, which we have 0.26, then square. When you do that, we got that trade. We all added up on all those things. So our portfolio, this thing is around 0.31 right now. So we were at a much higher, but when the market took a collapse last month, we went in. So our portfolio, what we are seeing right now is we are at 0.31, which is very profitable, and this has been proven to be working for more than 100 trades. Okay, so this is how you design the system, guys. You want to measure how much is your R mean, how much is your STD, standard deviation. Sorry, this is spelling mistake. Standard deviation, and how much is the ratio of the R mean to standard deviation. All these things we do, and we get this number. So this is the number that you want to strive, which is greater than 0.25. Okay. I just wanted to show you how we have done it for our portfolio. We only teach what we use, and we have been doing this, all these indicators for these things. Okay.
Hey, Srini, can I ask a couple of questions I have?
Sure. Is this Subara?
Yeah.
Hey, Subara, tell me.
Hey. Okay. So here, I would assume this one is for the current year, right? For the 2020. This.
Yes, we are only tracking this for this year.
This year, okay. So in the D2, you have 100K is the starting point. So if someone has what is listed like in the D3 and D4, you have 2 and 5, right? If someone has opted for 2, they have 63K as the returns, and someone has a 5 as their
Yeah,
like
they have made
size,
150,000 as a
they
profit.
have the 159 as the return, 159K, right?
Profit.
Okay. And as a part of your entry price, and whatever you documented here is entry price you suggested and the exit price you suggested. This is purely executed trades, right? Based on the
These are executed trades. It's executed in our accounts.
Okay. And so, for instance, here on the line number 10, entry is 4.75 and exit is 7. Probably you might have what you call alerted the entry point when it was 4.75 and alerted when it was 7. Obviously, people have to what you call follow your guidance and execute with the same discipline. So in that case, this is the returns they made.
Right. Actually, I wanted to, since you brought that up, the way we do is we do a couple of things, right? For example, recently when we did TTD, when we gave let me show you one of the things how we do so that you understand what we do. Okay, the 1 second, give me a minute. I wanted to show you this. I want to show TTD, which worked so that how we alert and what we do, right? Let me tell you. Thanks for waiting 1 minute. How do I show this? Is the question. Hmm. Okay. Don't worry about what you see here, but I'm just trying to show you something. Minimize this. Okay, are you able to see this?
Yes.
Okay, don't worry, I'm not able to, I don't know how to do it, but I'm on a Mac. Okay, if you see, this is the alert that first comes up, okay? When we say by December 4, TTD, 900 calls for 7 or below. I said risk level high because it's a very volatile stock and the ATR is very high. I mentioned why it is high. Because the nearest support is at conversion at 777. When we entered, it was around 820 or something, right? So that is what it is. So I told them what is it and how do we expect it to go. Now, when you see here, I gave the target options 20 and above, right? You see that, Subharu?
Yeah.
So basically what we did is we said, okay, we are going to look for a target of 20. That means 3 times, right? 3R basically. So
Yeah.
what we did is then when we reached today, we sold this. I mean, we alert people saying that, hey, it has reached 50%. Sorry, come on. See. We alert people saying, hey, it has reached 50%. It has done the doubled. If you want to take off the money, I always suggest people take off half the money when you reach double, so that you're playing with the the market money. You don't have to lose anything, right? Unless you're confident that it goes. So here, what we do is then we sold it at position closed, which means that we are no longer in the position. Today, with this alert came up.
Yeah. This is exactly the question I have.
Okay.
Yeah, one is like what do you call, saying it reached 50%, another is 100% and 150%. Basically, informing the whatever the channel, let it be a WhatsApp group or somewhere where people are subscribed, right? Second thing is telling them take the action. So the Excel file reflects what you call the price when you guys tell take the action. That's what I mean to ask. One is saying it's commentary anyone can give, right? Means if these numbers reflect, just I'm curious because I wanted to know if I know these returns are amazing. So that is the reason I'm asking. Sorry, don't think otherwise.
No. That's fine. That's fine. Definitely. What was the question, by the way, Subbaru? I didn't get
Yeah,
that.
means the price, exit price, what you quoted in the Excel, is it the price you said for your clients to exit at that price?
Yes.
Okay, thank you.
This is exactly what in fact, what I'm doing this now is like I'm pasting the entry that I had pasted it for our subscribers.
Yeah. The reason why I'm asking this, Srini, is there are some other places where people say like 50% it reached 75%, it reached 100%. So they don't say exit. Some people may exit at 50%, what you call, or 30% raise when it has a potential to 200%.
Oh, okay.
Unless someone who is
No.
alerting, he is confidently say to hold, people will not hold, right? So, if people, majority of the people, 9 out of 10 exited at 30% rise, and if someone is marking at 200%, it is different, right? From that perspective, just to get clarity, I'm asking.
I got your point, but again, as I mentioned, we are trading this. We are not teaching. We are not telling something that we are not doing, right? So that is why for me, I'm just an extension of our trading that we are telling our subscribers that, hey, this is what. There are a few people here. Maybe I don't know. Let me ask. Chandana, are you there? Chandan? No, not there.
Looks like he's on mute.
Okay. I just wanted to, rather than me telling, we should get their opinion directly. That's what I thought. But maybe they don't want to speak. I don't know. Chandan, are you there? If you don't mind. He's not talking, something like that.
That's fine, Srini. I can take your word.
Okay. No, definitely. This is what we do. Definitely, all the positions are done. Oh, sorry, he's at the airport. He can't talk, it seems. Okay, cool. Maybe somebody else. Anyway, I don't want to put anybody in the spotlight here, but this is what we do.
No, Srini, this is Prasad. I haven't done that many trades, but at least the trades that I've done, I followed the advice, and I think the exit points were right on the money.
Okay.
You know, sometimes the entry points were a little bit off because I probably did it a few hours later than what you suggested, but overall, it's been great.
Oh, okay. Thank you, Prasad. Appreciate it. Thank you, Pastor. Yeah.
Thank
no,
you.
because people want to hear your guys, your experiences rather than me telling. You know, it looks like I'm tooting the horn. That's why I wanted to make sure. Thanks, Prasad, for stepping in. Thank you. Yeah. Okay. So I think we are at the top of the hour, guys. So yeah, so all our returns are like very visible to you guys. Definitely, this is what we do, and we are blessed to have people like, you know, with all your wishes. We are marching towards our goal of 200% with our 5% portfolio and 100% in our 2% portfolio, and all this is in the span of 5 months, guys. So definitely we made mistakes. We do make mistakes, but definitely correcting it as we see, and you know, trying to be in a right frame of mind and being aligned with the market. Okay. For those of you who are new here, I just wanted to bring up the services that we offer. What did I do? Okay. So if you look at, this is our services guide, the subscription plan that we have. Basically, we every day strive to provide daily insights, and also we provide option trading ideas, telling what to do, what not to do, what we see. Some of them we may enter, some of them we may not enter, okay? For example, today I was suggested urban only if it crosses 28.16 flat line, but it definitely went below it, so we didn't enter the trade. So this free plan will definitely, it's a great way to learn the system and do things. But if you somehow want to know, like as I showed you the picks and how we give all the entry points, exit points, then we have a different kind of plans for you: monthly plan, 6-month plan, and a yearly plan. So this is what we have, guys. So definitely, I just wanted to show you for the information purposes, and if it is something that suits your needs, let us know how we can help. Okay. With that, we can call it a wrap, right? Any questions, guys? So next week is a very good session, guys. We'll talk about the trading plan, how to develop a trading plan, and I will also show you my personal trading plan. Okay, how I have developed the trading plan. What are the various things that I take care of? So in that way, you will get an example, and you can develop your own. Okay. So that I will call a wrap. Any other questions, guys?
Oops, Srini. Thank you.
Okay. Hey, good guy. Good. Hey, good to hear from you all. Then I'll talk to you maybe next week. We'll get for the next training. Okay.
Okay. Thanks,
Have
Srini.
a relaxed evening, folks. Thanks for joining.
Thanks, Srini.
Bye.
Thank you.
Thank you.